The Federal Reserve on Wednesday lowered interest rates for the second time this year in a continued bid to prevent unemployment from surging. But another rate cut at the next meeting in December is not a foregone conclusion, Fed Chair Jerome Powell said in a news conference, adding there were strongly differing views among policymakers on how to move forward. Fed officials voted for another quarter-point rate cut, lowering their benchmark lending rate to a range between 3.75% and 4%, the lowest in 3 years. Wednesday's decision drew two dissents, one from Fed Governor Stephen Miron, who backed a larger half-point cut, and another from Kansas City Fed President Jeffrey Schmidt, who preferred to hold borrowing costs steady. It is the first time since 2019 that there were dueling dissents, both calling for easier and tighter policy, underscoring the heated debate among officials over how President Donald Trump's sweeping policies on trade, immigration, and spending are affecting the U.S. economy. To make matters more complicated, it was also the first time officials have set monetary policy while lacking an entire month of crucial government employment figures in the modern era. Central bankers began to lower rates last month after data through August showed employers were adding jobs at the weakest pace since 2010. Major companies such as Amazon and Target have recently announced tens of thousands of layoffs. The problem: a prolonged government shutdown could stand in the way of further rate cuts, especially with some officials such as Schmidt concerned about persistent inflation pressures in the economy. Powell made it clear that the Fed doesn't have the full picture of the economy's health without government data. The Fed's latest policy statement noted that more recent indicators were consistent with earlier data before the shutdown that showed weak hiring and slightly higher unemployment. Powell said as much when taking reporters' questions. "There's just no story over the last 4 weeks, it's kind of stable," he said. "You don't see anything that says that the job market or really any part of the economy is making a significant deterioration." Data from payroll software provider ADP released this week showed that hiring picked up in September, but remained weak. And while there have been prominent layoff announcements in recent weeks, that doesn't immediately translate to higher unemployment. Workers who've been laid off sometimes receive generous severance packages. Powell mentioned that private data cannot replace government figures, which are widely known as the gold standard of measuring the world's largest economy. And the persistent absence of those figures could put future rate cuts at risk. "There's a possibility that it would make sense to be more cautious," Powell said. "The inflation situation also remains murky," Powell said. So far, inflation hasn't surged due to new tariffs that have gone into effect, according to the latest consumer price index, largely thanks to businesses managing higher costs without passing the buck to consumers. The Fed chief said that officials expect that there will be some additional increased inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. Economists widely expect tariff inflation to pick up as well, especially if Trump makes good on his recent tariff threats. The September CPI, which was released last week despite the shutdown for Social Security's cost of living adjustment, was cooler than economists had predicted, but it showed persistent price pressures that could worsen because of Trump's tariffs. Trump is meeting with his Chinese counterpart Xi Jinping late Wednesday U.S. time for a wide-ranging discussion in South Korea, which will likely include a potential U.S.-China trade deal. Powell reiterated that there's a reasonable expectation that tariff inflation may be short-lived, which helped pave the way for September's rate cut. But that would also remain unclear if the October CPI, which is scheduled for November 13th, isn't released because the shutdown persisted. Fed officials normally look to the Personal Consumption Expenditures Price Index, widely known as their preferred inflation measure, but that figure also hasn't been released due to the shutdown. Powell said once the tariffs have kicked in, the hope is that they stop generating inflation, reflecting a one-off effect. "This is how we believe and hope that it will work out," Powell said. In a separate decision, policymakers announced the end of a 3-year process to shrink the size of their enormous portfolio by December 1st. The Fed's portfolio, or balance sheet, reached about $9 trillion in mid-2022, but is now around $6.6 trillion after a careful effort to reverse the stimulus it introduced into the economy during the Great Recession and the COVID-19 pandemic. It's a tool that works in the background while the Fed's key interest rate does much of the heavy lifting to achieve its macroeconomic goals. Officials have judged that the balance sheet is close to a more normal state.